As is tradition, we're going to cover the Amazon earnings. They've been a big position in Steve and I's portfolio for a while, and see if you can figure out why. So this was first quarter 2025 earnings. Market initially didn't really like these, Steve. Sent it down about 4%, but it's ended up flat on the day, and it's had a pretty decent week as well. So I think the market thought these were kind of much of a muchness, and I think they're slightly better than that. But let's see what you think. Revenue came in at 155.7 billion. That was up 9%. Net income was 17.1 billion. That was up 64%, or a margin of 11%. Just to note that includes about 3.3 billion pre-tax gains from Anthropic. They generated about 17 billion in operating cash flow, and free cash flow was actually negative 8 billion, which we'll get onto a little bit later on. In terms of geographies, North America, 92.9 billion, up 8%, and about 5.8 billion in EBIT. That's about 6% margin. International, 33.5 billion, up 5%, and about a billion in EBIT, so up about 13% or so. In terms of AWS, they gave us some new interesting information on that, which we didn't get before. Revenue was 29.3 billion, up 17%. About 11.5 billion in EBIT, up 23%, about 39% margin, so really, really strong. New one Steve they gave us was AWS backlog. So this is the spend on AWS that's yet to be recognized by Amazon. That's 189 billion, Steve, up 20% year on year. And the weighted average remaining life is another new metric that they gave us. And this is obviously how long a customer has booked with Amazon in front, obviously yet to be recognized. That average is 4.1 years per customer. So people are booking AWS and choosing to stay there for a long time. So if we break it down into types, online stores was 57.4 billion. That was up 5%. Physical stores, 5.5 billion, up 6%. Third-party seller services was 36.5 billion, again up 6%. Ad services was 13.9 billion, up 18%. Subscriptions, 11.7 billion, up 9%. AWS was 29.3, up 17, as we covered, and other was 1.3 billion, up 4%. In terms of a guide, the guide came in just about where analysts wanted it, and I think this was some of the issue. They said net sales would be about 164 billion, and that would be up 11%. EBIT of about 17.5 billion, again up about 19 or so percent. There was quite a lot in the call, Steve, and I probably invite you to chime in on the numbers that we've heard here, and then we'll circle back to the call just to give people a break from my voice. Anything in there that's really jumping out at you, Steve, or is this sort of more of the same?
I was with the market and thought this was kind of in the muchness category. I mean, Amazon's reporting, it was reporting this week after Alphabet from the week before, I think level with a day after Meta and Microsoft as well. So sort of Mag 7, similar-ish, but not entirely the same. Operations have been actually all doing pretty well. Stocks generally going higher, and Amazon had caught a bit of a toe higher as a result. So they're kind of flat on the day, and it's flat on the day in a day where the market went up quite in a non-trivial way for the rest of the S&P 500. That's not much of a step back when you look at it. It had kind of been on its way up going into earnings. But I'm looking at the kind of growth numbers and the two bits of the breakdown. I always like that breakdown, by the way. It's the first thing I scroll to on the earnings release. Last page, pretty much, or penultimate page. And I'm looking for the two things I look for are the ad services business and the AWS business, because I think they're the highest margin bits of that business. Certainly they're towards the upper end. And the growth there is very good. In ad services, it's 18%, which is higher than either Alphabet, which was 8.5%, or Meta, which was 16% in the most recent set of quarters. In fairness, those are much bigger, more developed ad businesses, but it's good to see Amazon sort of doing well. And I guess in some sense gaining kind of market share in that, even if the others aren't necessarily going backwards at any meaningful rate. Cloud, it's the other way around, of course, between sort of Alphabet and Amazon. And AWS growth was sort of 17%, 28% from Alphabet. And we don't cover this stock in quite the same way because neither of us owns it and neither of us is really likely to. But Microsoft, worth noting that their cloud growth was very, very impressive. They came in at sort of 33% for the quarter, which is that's not a small base that they're growing that off 33%. And I think that's partly what managed to drag Amazon higher a little bit beforehand. Some strong stuff coming in, and Amazon's number came in at 17, which is, well, they've been running at 19 pretty consistently. Before that, it was 17. So it's around that 18% mark that this thing is growing fairly significantly. And it is, like we said, a kind of big operation as well. So yeah, I thought the numbers were kind of okay. It's not a big step back, even in relative terms to the rest of the market on today. Generally, I thought the numbers were fine. Nothing really blew me off my feet there, Steve.
Yeah, I agree with that. The only sort of caveat that I would add to it, Steve, is, and yes, I agree with your initial point that there are two or probably three aspects of this report that, as an Amazon shareholder, you really want to focus on, and that is the ad services, the AWS, and the subscription business. I would just tack on there as well because they're all fairly okay margin products from Amazon, but they're also kind of, when we originally used to talk about Amazon, we were talking about these things eventually being the things that come along and actually make meaningful change to the top line, the overall top line of Amazon. And they really do that now. If you look, online is up 5, physical's up 6, third party up 6, but the actual Amazon business as a whole grew by, that's North America, sorry, it grew by 9. So you can see these higher growth businesses are now beginning to accelerate. But one thing I would just urge you not to forget is these are hard numbers to improve now. These are big numbers, and in the terms of AWS, they're being constantly capacity constrained by the business and by this AI business that they've got at the moment, which is these are not things you can just throw up. These data centers, they cost a lot of money. They've got to be connected up, and yeah, this is something that was, they certainly went meandering along building these out, and they're being asked to hurry even more. So yeah, that's why sometimes when you look at Amazon's results and think to yourself, well, they're doing all this and the free cash flow is garbage, and you think, well, actually, that all that is Amazon's sort of cycle of capital investment into their into their products. So you'll see that cycle of free cash flow released from these projects when they're built, and then Amazon reaches capacity again, and they go all the way back around into new delivery hubs, new data centers, this, that, and the other. And that is just a constant cycle. You'll be able to see that if you just go through quarter to quarter to quarter on Amazon. Right, onto the call. They said that they were strong in key business areas. They said that their strength was fairly broad-based. One of the things they wanted to highlight was that Prime, they managed to improve the speeds of delivery for Prime. What they've been doing is something Steve and I talked about a few quarters ago, was trying out new ways of improving inventory placement and getting stock closer to people before they order. And that's actually led to record delivery speeds for Prime members, both internationally and in the US as well. So we certainly know that here, Steve, because we've just got same day Prime, and it's rapid. I mean, you can order something and within an hour and a half, it's here. I just didn't ever think that would happen. Definitely not in Hull. But yes, wide selection, they said, was one of their other sort of key areas of winning. They said that they offered customers choices at various price points, especially when it comes to everyday essentials, their grocery arm, essentially. So I said there were some one-time charges. North America and international EBIT margins were negatively impacted by one-time charges. This is related to some unresolved returns and a pull forward of inventory due to tariffs. So essentially what they mean by that is they've been buying to try and stock up to avoid the initial issues that would come from tariffs. And they also offered a wider guide range, and this is mostly due to this increased uncertainty at the moment that we have, and you've seen that in the revenue and EBIT guides that they gave. So they're improving their inbound network. They said they've re-architected the inbound network, boosted fulfillment and transportation productivity. This has led to them being able to improve inventory placement, get more items in a package, which means lower delivery costs. So we should see the benefits of that moving forward. In terms of fulfillment efficiency, they've had years of focus on regionalizing this fulfillment network, and they're now seeing the benefits of that. This is faster deliveries, fewer packages, and again, lower costs. When they were pressed on tariffs, they said they were really unclear how tariffs would settle. But they did note that customers and Amazon have done forward buying to try and avoid some of this, and you'll see that happen, and those results in again in coming quarters. They reckon they've got a unique selection advantage. I think that's true. They basically said their large and diverse selection helps Amazon weather challenging conditions and meet unexpected product trends. And that they remain focused on low prices, broad selection, and convenience to drive customer trust and long-term shareholder value. On AWS, they said AWS's annualized revenue is about $117 billion at the moment, and growth in both generative and non-generative AI. They think that AWS revenue is a bit lumpy at the moment. They said enterprise sales cycles and startup growth unpredictability can make AWS's revenue a little bit lumpy, but it has massive potential. About 85% of global IT spend is still actually on-premises, not on the cloud, and that indicates that AWS has a significant future ahead. And they're also lowering compute costs as well. They said that AWS is basically exists to lower compute costs and inference costs when it comes to things like AI adoption. They've launched a new version of Alexa. They've called it Alexa Plus, and it's a new personal assistant, free for Prime members, or if you're not a Prime member, you can take out a monthly subscription for it. They're developing AI agents using a package called Amazon Nova Act. And these are able to perform complex tasks, even operate web browsers, and basically they're aiming for really high accuracy in the services that they provide. And they said that the AI business for them is a multi-billion-dollar AI. It is a multi-million-dollar business. Amazon's AI business has multi-billion annual run rate. They said it's growing triple-digit year on year, but as we mentioned earlier, just capacity is a problem at the moment. They are really constrained. Advertising is a strong contributor to profitability, 90% year-on-year growth and strong adoption rates and full funnel offerings from Amazon. It's got a lot of appeal to people that want to use it. They said they're becoming the dominant DSP, that's demand side platform. And they said this is basically just due to its audience and its measurement capabilities across property and external sites. And they just wanted to basically sort of double down on that long-term strategy. So the long-term focus at Amazon has been lowering the cost to serve, leveraging logistics infrastructure, and improving EBIT margins through advertising. They want to continue to work on AWS, investing heavily into AI, which again will help lower compute costs. They said to expect lower free cash flow in the near term, both due to that sort of inventory pull forward and also just the amount that they're having to spend on AWS at the moment to try and quicken that capacity rollout, Steve. So, yes, I hope that was that was a flavour of what's in the call. There's lots in the call if you want to go back, including the Q&A, which was pretty good as well. But yeah, I hope there's something interesting in there for you, Steve. Anything jumping out?
The tariff thing really annoys me. It annoys me for not just for Amazon, to be honest, not even just for companies that I own shares in, but I'm increasingly seeing people are doing the thing that they need to do, which is kind of piling up stuff on the right side of the border for the side they do business on, whether that's in or out of the US, with a view to getting there ahead of tariffs. And as you rightly point out, it cuts into free cash flow, because if you use your operating capital to buy inventory, it doesn't turn into free cash. I don't blame anybody for doing this. I think one of the reasons I'm mostly annoyed is because I don't think I own anything that really stands to benefit from this. It's going to make things confusing a little bit for a number of companies. But I think in some cases what you're going to see is kind of short-term tariff beneficiaries and demand getting pulled forward, and then there's going to be kind of issues coming out the other way. So I think maybe worth keeping an eye on whatever companies you think they might be that are kind of seeing increased demand as things get imported ahead of time. one stock actually I think that does stand to benefit on this, and it's not one that I own, but it is one that you own, Steve. I'm not sure when they report, but Prologis seems to me like an obvious beneficiary here. People are busy piling up inventory in the States. They got to put that inventory somewhere, and where they're going to put it is in warehouses, as far as I can tell. So they're going to get some pretty decent demand. I think that's Prologis saying as well that they're expecting to be a kind of beneficiary of this in the short term. So watch that one carefully for a little bit. I'm impressed at the way Amazon's pulling stuff forward, but one number really jumped out at me that you mentioned there. 85% of IT infrastructure or something like that is on-premise rather than in the cloud. Um, that's almost unbelievable to my mind. I was in the impression that stuff was shifting across gradually. I didn't think it had completed yet, but if you'd asked me how much is on-premise and how much is in the cloud, I would have said, I guess 60-40 cloud or something like that. And then we're kind of most of the way there because I figure that everything that's starting is going into the cloud and not on-premise. And all the tech software, Celebras, Guidewire type companies that I look at seem to be constantly shoveling people over to these subscription cloud models rather than license on-prem stuff. And there's such a long way to go. And that just looks like a huge runway for, frankly, any of the cloud service providers. It doesn't actually have to be Amazon, but including Amazon. This isn't just me talking my own book. That number absolutely jumped off the page at me when you mentioned it. And there's huge amounts of opportunity ahead there. The thing with Amazon's reinvestment, and you point out it makes free cash go negative, if you can get cash out the door at the right rates, it's the right thing to do. Quite simply, if you think they can invest it in a better way than you can, and I can't invest Amazon's free cash in a way that will build a data center that's any use to anybody, might as well let them do it. And I'm always reminded with this that it's kind of why we own businesses, right? Because they can use cash better than you can, assuming you find the right one. They can do it to invent new things or develop new things, improve their existing things, expand things, so on and so forth, and they can get a 10, 15, 20, whatever percent return on that. And I don't have anything that I can do with mine that will turn it into a 10, 15, 20% return, other than maybe stick it into a business that I think will do that. Can't do it with cash, can't do it with bonds, don't have a business of my own that will generate a decent return on that capital. So in many ways, in fact, it's encouraging to see Amazon continuing to reinvest and thinking it has a long runway ahead, because that's why your money is in this. It's why my money anyway, and I assume the same is true of you, is in this damn company, because it can find ways to do things with capital that are impressive. And it sounds like there's kind of quite a lot there, especially if it involves kind of figuring out how to basically preempt your order before you've ordered it and get your inventory to somewhere near where you are so it can arrive just as you're pressing the buy button. Yeah, impressive stuff, isn't it, Steve? I mean, I can tell you're impressed. Never thought you'd live to see the day, and they've brought same-day delivery to Hull.
Oh, well, yes. I mean, Hull, Steve, has been in the dark age for forever, and for us to get same-day Amazon delivery, and we now have more than one internet provider. We're really going up in the world here, Steve. Two books I will just put forward for people who want to read more about Amazon and the sort of the thought process behind it. They're both by the same author. I think they're both by Brad Stone. He's from Bloomberg, so he's quite well connected. But the Everything Store, and the second one is called Amazon Unbound. So the Everything Store gets you up to a certain point of Amazon's history. I think it's about the 2010s or something like that, and it goes through obviously the .com crash as well, which is really interesting. And Amazon Unbound is about how Bezos pushed Amazon forward. And in those books, there's quite a lot about AWS, and they're pretty confident at this point, Steve, that AWS is going to become a $100 billion company, and they think that'll be about the end of it. So AWS is already 118 or whatever it was $1 billion company, Steve, and 85% of computing spend is global IT spend. Sorry, is still on prem. So I think it's fair to say a multi-hundred $100 billion company is what this has the potential to be if everything gets shared out nice and equal. Yes, very good, Steve. I mean, I'm like, that's the number that jumps out to me as well when you look at that, because as I've said a number of times, AWS is the one. It's the kind of to use the phrase from the podcast you sent me, it's the crown jewel of the business, and to see it still growing so well and with great margins, and Amazon reinvesting, and then to see that the runway for it is so huge. Yeah, it's looking good, and I just think Amazon for me at the moment is just something for me to just sit on, and we'll see what happens from that point onwards. Steve, what's next?
Interesting. I'm much closer to buying it than you are, in that case, if you're planning and just sit. But you've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.